Hello, everyone. Welcome to today's webinar with myself, Fawad Razaqzada, and my colleague Victor, who
Hello.
is more of a macro analyst. I'm more of a technical analyst. So we kind of complement each other very well in these webinars, don't we, Victor?
Indeed. It's a
Yeah.
pleasure.
Thank you. Today's webinar is basically going to be live, as are all Tuesdays webinars. We talk about the currency markets. We talk about the indices, commodities, cryptocurrencies. So for those of you who have joined us, first of all, welcome to today's webinar. And secondly, please make sure you ask us questions in the chat window or in the questions box. And we will be more than happy to take your questions and answer them as we go along. For those of you who are watching a recording of this, please make sure to join us live next time so that you can ask us questions, and we are more than happy to provide analysis on any particular market you are interested in. That said, let's now begin the webinar. And before we do that, it's important to be aware of the risks involved in trading. So I'm going to read the first paragraph of the disclaimer. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So this webinar happens every Tuesday, just a quick reminder, and it's mainly a technically focused webinar, but we do touch on fundamentals, and there will be a Q&A session at the end of the webinar. Now, we're going through these macro events very quickly. Today, we don't have too many very important economic numbers. I think the housing market data from the US is going to be not too important unless we see a massive beat or a massive disappointment. On this calendar, I think the flash manufacturing and services PMIs on Friday from the Eurozone are going to be the main macro highlights for the week, which could move the euro and the stock indices on Friday morning. But is there anything else that stands out to you, Victor, in terms of the macro economic highlights?
No, I can't say that I can highlight anything in particular. Perhaps some jitters in the cryptocurrency markets can also spread over to broader risk assets. So let's see how that goes.
Yeah. So keep an eye on cryptos as well. Anyway, so this is what's coming up this week. Now, let me transition to the charts and start off with the dollar index. As you can see, the dollar index has continued to head lower. It looks like the big jump in inflation numbers that we saw last week is now a distant memory. The Fed has come out, lots of Fed speakers came out after the jump in inflation. And they literally say that, we think that inflation is going to be transitory and that they're not going to tighten monetary policy as a result of what they think will be a short-term deviation of inflation above target. They think that inflation is going to go back down or an average around 2%. And for that reason, they're not too worried yet about rising inflationary pressures. That helped to calm investor nerves, and the dollar continued to head lower against all major currencies, including the euro, the pound, and especially the commodity dollars, like in particular the Canadian dollar, strengthened further. And stock markets, they managed to rebound as well because yields fell after a brief spike higher. And we saw the Dow, I think the Dow hit a new record high. European markets also climbed. So there wasn't too much concern about that big rise we saw in inflation, in CPI inflation on Wednesday, after that initial knee-jerk reaction. So the dollar index here is continuing to point lower. We are continuing to see lower lows and lower highs, and each time it tries to stage a bit of a recovery, it quickly gets rejected. For example, last week we saw a bounce, hit resistance here, and then it sold off. Previously, it rallied from here, hit resistance around this area on 2 occasions here, sold off. And we're seeing resistance levels being defended and supports broken. And that trend is going to, I think it's going to continue for now until we get to test the 2021 lows and the 2020 lows around this area. And let's see what happens. Okay, so this area was previously support. This is going to be a key resistance level to watch in the short term. I think what we could see from here is the dollar may bounce back a little bit, test this area, and then sell off again, and then drop to test liquidity, resting below the 2021 low that was hit in January of this year. What the dollar does then is really up in there. So if you see a drop and a quick rejection, something like that, that would create a false breakout scenario here, possibly signaling a bottom for the dollar. So that's one of the key scenarios I'm watching out for a potential dollar recovery in the weeks ahead. So first, I want to see the dollar break this level down and then quickly reject it and then go back above. So that would create a false breakout scenario, something that we've actually created lots of YouTube videos on. If you go to our YouTube channels, you'll see. Let me just bring that up while we speak. If you go to our YouTube channel, youtube.com/think markets, go to the playlist, and I have created a key reversal pattern series. It contains a couple of or a few videos in there, and we've also got the trading the failure of a key reversal pattern. So if you go to the reversal pattern series, there are a few key reversal patterns that I have talked about in these videos, and the one I'm talking about is the false break pattern. So when you have some time, watch these videos. You will learn a lot from them. It will help you see things, potentially see things differently, and that's the kind of setup that I am half anticipating to see on the dollar index. So I think that it's going to drop and break through this low and then reclaim that and potentially form a low. So if that happens, that would turn bullish. The dollar would turn bullish. Alternatively, what you could do is wait for the dollar to break its most recent high. So in this case, I have marked out this high, which was the last high prior to the index breaking down. So if it were to recover from here and go on to take out that previous high, it will create its first higher high. Okay, so when it does that, or if it does that, that's when you can drop your bearish view on the dollar, at least in the short term, and we could see a short to squeeze rally higher. So at the moment, the most recent high is this one I've selected at 90.90, right? But obviously, as further price action unfolds, we'll have more lower highs that you can work against. But the dominant theme right now is the dollar weakness and strength for risk assets. So if that continues, then we could well see the dollar head much lower from these levels, and that in turn could see the likes of the euro dollar, the pound dollar climb to, I don't know, 125 and 145 respectively. We could see gold and silver continue their upsurge and so on. So that's the underlying trend right now. Will it continue?
So yeah, we have already seen some currency pairs marking new highs against the dollar. I'm speaking, of course, about the Canadian dollar first, because that we have highlighted last time we spoke a monthly support line around yeah, there it is, that
That's
that we
2017 low.
have,
Yeah.
yeah, which we have tested, and you know, as you mentioned at the time, we could
Yeah.
have a breakout below, but watch out, because that may be only temporary. But we'll see. We need to see the Fed
Yeah.
reverse their extreme dovishness for that to happen.
Yeah.
And for now, it doesn't seem likely.
Yeah, absolutely.
But, you know, come summer, that could change,
Yeah.
because you need to take into account here that there is a midterm election coming next year, and if inflation is at 5%, I don't see any way in which Democrats can win this, because personal purchasing power is going, consumer purchasing power is going to be dropping significantly, and
Yeah.
you know, this we cannot forget about Fed independence. They just do what they're told. It's pretty
Yeah.
clear by now. So let's see what happens.
Yeah, so it looks like, you know, since we're talking about the Canadian dollar, one thing you have to take into account is momentum. Okay, so as much as we think the dollar is oversold, the US dollar is oversold, the momentum is very strong. So each time it tries to stage a recovery attempt, like last week we saw this hammer candle. I thought that might be the low, to be honest, because it breached the 2017 low, and it created a nice hammer. There was very little follow through on the upside, and then after this green candle was formed, on the very next day, it took that the low of that candle out and closed below. So that was that signal to us that this is possibly going to fail, and so it has proved as we've broken below the low of that. So you can see that each time it creates a bullish reversal or a bullish sign, it doesn't work. And this kind of price action has been repeated time and time again on this pair. As you can see, for example, here, tried to stage a move higher, couldn't do it, broke down. Lots of examples like this. So as things stand, I think it is very likely that the dollar CAD is going to test the psychologically important 120 handle now. Before deciding on its next move, we could see rates come back up to retest the breakdown area between 120.45 to 120.60, which was previously support, before heading lower. So I'm talking about the shaded region here. I have marked out the most recent high at 122.03. So if the dollar CAD were to go above this high now, it will have created a higher high. So that level is now the line in the sand insofar as the bears are concerned. Should that level break, then it could lead to a sharp short to squeeze rally, possibly towards 123.65, but maybe even to 125, which is a more significant resistance level. But for the market to get to those levels, it will need to create a higher high on the lower time frames. So that's the dollar CAD. You know, we mentioned the euro dollar. This was the projection we drew in the previous webinar. So far, it's looking like it wants to continue heading higher in that general direction, and each time it has created bearish looking price action, like for example this candle right here. You know, there was some downside follow through, but support held at 120, and then we saw further bearish looking price candles form a few days ago, but then support once again held where it should have at around 120.70ish, which was the base of that breakout. So the euro dollar has created lots of bearish looking candles, but price action hasn't really followed that. Now from here, the most logical target for the bulls now is the liquidity resting above this inverted hammer candle, which was the previous previous high where the euro dropped sharply from. So people who have been shorting the euro dollar, they are trapped, right? So some of those guys will have placed their stops above this high, and that's exactly where I think the euro dollar is headed now to. So specifically above 122.43. So call that 122.50, a few pips above it. That would be the next logical target for the bulls to aim for. And then we're talking about big stops resting above this previous six swing high at 123.50. So in my view, it's becoming increasingly likely that the euro is going to head towards those levels in the coming days. Not that I'm particularly bullish on the euro, but from from a macro point of view, but technically that's how it looks right now. And as long as we are getting higher highs and higher lows and so on, then there's no reason to fight the euro or indeed any other currency pairs against the dollar. So I can now push
it's basically rather a dollar move than a euro move.
Absolutely.
We have seen a number of prominent investors, most recently Stanley Druckenmiller, who used to be a partner of George Soros when they teamed up to depeg the pound from the European exchange rate mechanism. So he highlighted yesterday that the current fiscal and monetary policies in the US are risking the status of the US dollar as a global reserve currency. So coming from this wise macro guru, really, this is something that people should pay attention to when
absolutely
when identifying their major kind of directional trades. So for the time being, until policy hasn't changed, the dollar is likely to continue gradually and perhaps at some point abruptly sliding. So we were speaking last week about this big it actually happened on the same day that we were speaking, that there could be a correction from 2150. It actually happened, just as you highlighted, and we broke through the previous high today, and I'm looking for a pullback that could be a buying opportunity.
That's it. Like I think we need to kind of take it from one level to the next, and right now in the case of the euro dollar, this swing low here at 120.51, this right here, was the last low created prior to price breaking out. So for as long as that level holds, the path of least resistance remains to the upside. Even if we deviate a little bit below the shaded region I've just drawn, that it will still be bullish so long as this level holds. If this level breaks, then we could see a deeper pullback. But we'll cross that bridge if and when we get there. For the time being, the path of least resistance is clearly to the upside. And as Victor mentioned, we may get a small pullback heading, which could then be bought, leading to further gains in the days ahead. And we're seeing similar picture in other currency pairs. And this the cable, previously we had drawn this path for the cable when it was still inside this consolidation zone. I said in the previous webinars that it was very likely that it would break higher, and that's how it has turned out. Now, in the case of the pound, you have the UK economy. Sorry, my daughter has just stepped in. Victor, could you take over while I?
Yeah, sure. So we have highlighted that the British pound is likely to continue on its path higher now that the risk of Brexit has been repriced by the market, meaning that it's a long process. This repricing of Brexit is going to continue over time, as obviously demonstrated by the economic numbers. The worst fears about Brexit have not materialized, and life goes on after Brexit. And the pound is not going to disappear from the face of Earth, contrary to what some even central bankers were saying. So what we're looking at here is probably a very prolonged uptrend in cable. It started all the way back in the beginning of the year, you could say. Well, it started before that, but it continued from the beginning of the year. And after this significant pullback in March, that marked a top around 42.43, 40, basically the 42.50 area. This is where we're looking at next. We would be carefully looking for opportunities to buy cable again. It's currently making a new high just above 42. So after it visits the 42.50 supply area, probably there are some sell orders there and some stops as well that could be taken out. So we're looking at another leg higher towards 144 and 145. If you switch over to the weekly chart, we have these more long-term levels. 144 is a previous high from 2018. Actually, it's double top. It's 43.60, 44 basically should be between 43.50 and 44. There should be some offers around that area. After we clear that level, if we clear that level, this move could actually accelerate. Who knows?
Yeah, it's very constructive how the cable, it spent several years in this sideways consolidation between 140 to 120. Yeah, and once price decides to break out of a lengthy consolidation, you will get a very strong, or you will tend to get a very strong continuation in the direction of the trend. Okay, so always bear that in mind. Remember what happened to gold. Let me show you just to make my point clear. If you saw gold here, it spent, from April 2013 to July 2019.
Spent years
in consolidation
in this 300 300 range, $300 range, and after we broke out of there, we easily had a $600 move. So double the range.
I'm talking about gold. Look how it hit the new record high, and then it pulled back, and everyone was calling for the top. And it could well be a top. Who knows? But look where the rally, the sell-off has ended, right at the 38.2 February trace of the entire move up. So on a percentage basis, this downward move from August of last year was only like a 32%, a 38% move against the longer term trend. And there was a ABCD formation around that area as well, from where gold has subsequently bounced from. But anyway, going back to the cable, so lengthy consolidation. Now we've got the breakout. What I want to say is this consolidation right here is very bullish, isn't it? Usually in an uptrend, what you want to see is a move higher and then a retracement and then a continuation. A retracement or a pause in the bullish trend. In this case, we've seen a pause, right? In the grand scheme of things, it wasn't too much of a retracement. Price only went down from 142 to 137-ish or something in the space of many weeks, which wasn't a considerable drop in any case. So this bullish consolidation has been resolved now by price breaking out of it to the upside, not to the downside, right? So this in itself is another sign that buying pressure was building and now it's been released. The sellers are stepping aside, allowing the cable to go on and take out resting liquidity above previous highs. So it's looking very bullish. And don't forget also, like, if you like your trend lines, there's a monthly trend line going all the way back to 2007 even, that has been taken out a few months ago, actually several months ago, a year ago even. And since that breakout, the cable hasn't really looked back on the monthly time frame. Yeah.
And the last kind of level is around 144. Then we have obviously 144 followed by 145.
145, yeah.
And there are some bottoms in 2013 and 15, if I'm not mistaken, that are going to prove to be the target.
Around here.
Term. So yeah, 148.
I reckon 150 is going to be the next big number.
Yeah.
150.
Well, 150 is very actually important because this is pre-Brexit level.
Yeah.
Imagine what happens if we break through that.
Exactly. Obviously, it might not get there in a straight line. I don't know how long it's going to take, but given everything that's happened from a macro point of view and this technical breakout, etc., everything points higher right now. Granted, the cable may struggle, in the next few weeks, and we may even see a deeper pullback. But in the longer term, I think we are headed to 150 before we see the next big macro move. So that's the situation with the cable. I think we've covered a few currency pairs. Shall we move on to indices? Because
sure.
Yeah, I mean, the Nasdaq, obviously, all the focus has been on that Nasdaq because of the rising bond yields. Let me show you bond yields very quickly. Yields, there you go. So last Wednesday we had very strong inflation data from the US, which caused yields to rise, caused the dollar to momentarily rise, and caused technology stocks to drop, because technology stocks are kind of growth stocks, which have low yields, right? So dividend yields, I should say. So when yields on the treasuries rise, this weighs or erodes some of the attractiveness of technology stocks. Okay, but the Fed came out and they were very keen to get the message across that they're not going to tighten their belt anytime soon. So the Nasdaq has recovered, finding support right where it should have. In fact, it went a little bit lower than I expected, but this level right here was the base of the previous breakout, right? See that down move, the last down move before the index broke out, came right down to that level and it bounced. Now it is testing potential resistance, which was support previously around 13,400. It looks like it's going to break through this to the upside, because the other major indices have done that as well. Like if you look at the S&P 500, this was a resistance area that should have held this right here. Once we broke below that, it should have held below it. It didn't. It went above and it stayed above for now. The other major US index, the Dow, I can't see the Dow. Where are you? There you go. The Dow as well should have stayed below this level here. Once it broke below it, it didn't, and it moved above. So we're seeing very similar pictures in European markets as well. The DAX, this was my invalidation level for the longs. Okay, I said if it breaks through that level, then it's going to drop. Well, it came down sharply to that level and it bounced, deviated slightly, and then it trapped the sellers, and it went on to hit a new record high above this. So from that area, it has now retreated a little bit, but the underlying trend is clearly bullish. And until we now get a low below this most recent low, the path of least resistance for the DAX likewise remains to the upside. But yeah, how long do you think this rally is going to last, Victor? Because it's getting it's getting to levels where you are starting to think that it's no longer kind of no longer
sustainable.
Right? If you're an investor in the stock markets, why would you rather stocks at these levels?
Yeah, well, the reason we have stocks at these levels is primarily because we have yields where they are at even lower levels, especially in Germany, where the 10-year yield is probably still negative. It's barely negative now.
Yeah, it's getting very close to that zero level.
it's getting closer to the zero level.
Yeah,
and it hasn't been there for quite a while. So
May 2019 was the last time it was trading around zero.
Yeah. So where was the DAX trading back then?
May 2019. Right here.
Yeah. So about 3,000 points lower.
Yeah. Around here somewhere.
Provided that we don't see any risk events, I feel like this rally could go on at least until the ECB decides to finally pull the plug on its extended monetary support, which could happen. I'm not like we historically there have been a couple of cases when the ECB started tightening before the Fed.
Yeah.
And this happened in the run-up to 2008 crisis, actually, if I'm not mistaken, in 2016. So that kind of made European stocks underperform when compared to US stocks. And it's possible that we're going to see the ECB move before the Fed this time too. I'm just thinking that the notorious German wing in the central bank could have a louder voice than many expect. So watch out for that. In the meantime, we're seeing that this level around just above 15,500 is proving to be a tough nut to crack.
Yeah.
We have visited it 3 times now. So let's see what happens.
Yeah. So if it breaks above this, then a trading idea would probably be to look for dips back into this area to be supported, leading to further gains. Whereas if we break that recent low, then that could lead to a breakdown to the longer term trend line, or possibly a bit lower. In any case, it's best to wait for the market to tell you what it wants to do before taking on a trade. But while Victor was speaking, I just drew a Fibonacci extension from the pre-pandemic high to the March 2020 low, and you can see that the DAX has now reached the 127.2. Well, it has reached the 127.2 previously, but that's where it has stalled. Suggesting that people are taking profit around this Fibonacci level. Remember, the Fibonacci extension levels are used primarily in markets where they are trading at record highs, because you don't have prior price reference points to base your targets around. So this is where the Fibonacci tool can become a handy technical tool to provide you objective targets, right? So that's the 127.2. Yeah, go on, sorry.
So we have a question from H.H. Hassan.
All right, go on.
He says that he's seen some info online predicting a stock market crash this year. So he's asking if this view is justified and what may lead to this happening. So I wish I would know what will lead to this happening, but markets are not a stable environment. The world is not a stable environment. Anything can happen at any point in time. My biggest fear is geopolitical. Basically, the relative peace globally that has lasted over the past 75, 80 years is worrying for me from a historical perspective, because historically we typically have about 70, 80 years of stability and then 20 years of chaos. I don't like, that doesn't necessarily mean a hot war, meaning it could be a war when not that many shots are fired. And imagine a cyber war that actually something that already happened last week, the pipeline in the US that got shut down throughout a week. So the east coast of the US was running out of fuel, and there were gas shortages. So this is the type of events that you want to be mindful of, and obviously the rise of China it already took control of Hong Kong. It basically violated a treaty that was giving Hong Kong independence until 2047. So many people are now worried that same thing might happen to Taiwan. So, these are just a couple of scenarios that could be very damaging to risk sentiment and to the stock markets.
Yeah, can I also add that no one knows, okay? No one knows when the stock market crash will happen. You can't predict it. The charts can't tell you when it will happen. When it happens, you will know, because the markets will crash and it will make lower lows and lower highs. And every year, you will get corrections in the market. So you have to be careful. Is it a correction, like 8% down and then a continuation higher? Or is it a proper massive decline in asset prices, like 20% or something, or even higher? you will get periods of heightened volatility in the markets because of some macro events or just technical selling or whatever. It does happen, and it can happen. Predicting it is the hardest job in the world, I think. So I would, if from a trader's point of view, what you want to do is you want to be going with the trend, okay? And because you're a trader, you'll always have your stop loss orders, right, in place. So even if a crash were to happen, it shouldn't worry you because you have your stop to protect you from losing a big chunk of your investment, right? So that's where traders need to concentrate on risk management of each and individual trades rather than worrying about a big correction. Now, if you are... go on.
Sorry, go ahead. Okay, I'll go ahead. Another thing that you should be mindful of is inflation. Traditionally, the stock market doesn't do very well when there is a high level of inflation because it starts anticipating tightening of monetary policy. And there is no reason, if inflation breaks out really, for the market not to start pricing in that the central banks are going to react to this. Just because obviously the past crisis in 2020 was the most damaging to poor people. So inflation is also something that is hitting mostly the lowest income people around the world, and if inflation gets out of control, you need to be mindful of big risks to the stock market rally, because that's after all, the mandate of central banks is to keep inflation at bay, and regardless of the fact what they're saying now, that inflation is going to be transitory, don't worry about it. The moment when inflation really accelerates, they're going to be forced to act.
Can I add on this point that inflationary pressures have been rising? Here I've got the 12-month candles. Okay, so each candle represents 1 year of price action, or in this case, this is not a completed year, so this is the current price action for 2021. These are some of the commodities that we look
lumber?
at. Sorry?
Is this lumber?
Yeah, this is lumber. This thing has risen so far. Well, it's come off the highs, but year to date, it's still up 52%. Okay, cotton is up 6%. Last year, it went up. Some reason it's not showing the percentage, but it went up big, right? This is cotton as well. I think this is coffee. Yeah, coffee futures, 17%. This is palladium, I think. Yeah, palladium has been rising consecutively each year for the last six years or so. Soybeans,
key component in
rally. Wheat, look at that. Wheat is up 10% this year. It rose 13% last year, and 13% the year before that, 19% the year before that. Corn prices have surged 41% this year so far. Last year, they went 26% higher. These are some of the commodity prices that are rising in value, in price, and it's putting up input costs for manufacturers and producers. And so what happens is, let's say, a company makes bread, right? They have to use wheat. They have to buy wheat to make bread, right? So now they're paying 10% more for the same amount of wheat than previously. Because of their margins being so tight, they will have to pass on these raised input costs to the consumer by hiking the price of bread by, say, 10%. That 10% rise in bread will be added to the CPI calculations eventually. Economists predict that when input costs rise, it takes about 6 to 8 months for it to filter through to the CPI estimates. In some cases, a bit longer. So in the months ahead,
and let's add to that fuel costs, which
fuel costs, crude oil. Look at
that. Much higher when compared to last year, and you have a recipe for disaster.
Yeah, everything is going up. Copper. Did I mention copper? Look at the copper. Bloody hell. 35%. Now, copper is used in lots of things, right? In electric cars, anything electronics.
In conventional cars too.
In conventional cars, this is going to add to the cost of producing, long-lasting manufacturing goods. I think everything is pointing to very high inflation in the years to come, but the Fed does not see this as being permanent for whatever reason. So I think inflation is going to be one major reason why the markets could actually crash, as Victor mentioned, and we are seeing rising inflationary pressures across the global economy. So also don't forget that interest rates are at record low in a number of major developed economies at zero. House prices are rising. So imagine.
House prices are rising to a point where they're pricing out a huge part of the population out of the housing market. And when that population becomes irritated with it, they're going to vote in populist governments all over the world that going to take some steps probably to tax people who have more income in order to basically open up the housing market to those that are that have less earning power.
And can you imagine what's going to happen once interest rates rise like 1 or 2%? It's gonna
that's crazy.
Monthly mortgage payments for everyone, and that's gonna add to the consumer bills, right? Whatever way you look at it, it's the financial markets are on a very unsustainable path at the moment. And
which brings me to cryptocurrencies that we still haven't discussed, and maybe we can touch on that.
So at some point, the stock markets are going to crash, but timing is key. And until that happens, I think buying the debt makes more sense. Now then, cryptocurrencies. Where do we start? Should we start with Bitcoin? Bitcoin is bouncing right where it should be bouncing. This area was the previous all-time high hit in January of this year. We broke cleanly above that area, never came back down to retest it until yesterday. Yesterday, right on the money, it dipped to this level and it bounced. Doesn't mean that the worst of the selling is over for Bitcoin. It just means that it has held support for now. It needs to break through resistance now in order to.
So where would you be feeling comfortable to go long once we go through that shaded area?
I think this is now the key level of resistance that needs to be taken out before I think people will be encouraged to buy Bitcoin again. Now remember, Bitcoin is obviously it has had a massive move up, and some people still think it's overvalued. And recently, well, in the last few days, Tesla, they have suspended accepting payment Bitcoin as a form of payment for the electric cars because of concerns over the environment. Mining Bitcoin using fossil fuels is something that's ongoing across the world, especially in China, and that means that it's becoming politically difficult for some companies to accept Bitcoin as a form of payment because they want to be reducing their carbon footprint, right? But by using Bitcoins, they are indirectly encouraging people to use fossil fuels and other forms of dirty energy to mine Bitcoin. Obviously, Elon Musk has said that he's going to accept paper what do you call it, Bitcoin once again, if and when miners start using more renewable energy sources for mining Bitcoins. But that's not going to happen overnight.
Can't see that happening anytime soon.
Yeah, absolutely. So what might happen going forward is more major companies might not think twice about accepting Bitcoin and other cryptocurrencies that produce that have, what do you call it? What's the word? I forgot. That are basically using a lot of energy to mine.
Proof of work currencies versus proof of stake currencies.
Yeah. So that's something that could go against Bitcoin. But other currencies, cryptocurrencies, are doing okay. If you look at Ethereum, for example, Ethereum has been flying, absolutely flying. Okay. Recently, though, it has come down a little bit. It says pull back to the 21-day exponential moving average. The reason I have the 21-day exponential moving average on my charts, let me tell you why. Okay, it's because when a trend is really strong, usually, but not always, but usually, the pullback tends to come to an end around the 21-day exponential. Just look at this chart. You can see how 21-day exponential has provided support on a number of occasions in the past. So today, Ethereum is trying to form a bullish-looking candle around this area. If it manages to close around current levels, then it will possibly provide a bullish signal, which could see Ethereum go back to $4,000 or even higher in the days ahead. Remember that the 4,000 level was a important level from a
quite big,
from a Fibonacci point of view as well, because this is where the 261.8 extension of the last downswing from January 2018 kind of converged with the psychologically important 4,000 level. So no surprises to see some weakness coming in on Ethereum at around 4,000. But now that it's had the pullback, it may now resume higher. What do you think, Victor?
So we have another question from HH Hassan, who's asking when will interest rates start rising? I wish I could tell you that. I wish I was in the head of Jerome Powell or Janet Yellen or somebody of those people. But basically, you need to have you need to keep track of the 10-year yield. Yeah. Usually, the market is the one that is pushing the central bank to act. So, despite the fact that currently the Federal Reserve is buying a lot of treasuries, interest rates still have been rising over the past, since the beginning of the year, really. And if the 10-year yield breaks through 180, I would say that markets are going to start becoming very, very worried about rising inflation.
Yeah. In my opinion, monetary policy shouldn't be this loose right now anyway, because the global economy has emerged from the height of the crisis, from the pandemic. And what central banks want to do is to have some ammunition left for when things get bad, if they do get bad again, because right now they can't do anything else other than print more money, right? So what they want to do is raise interest rates a little bit, just so that they have some room for maneuver should things turn ugly once again. So in my view, central banks should be starting to tighten their belts to at least reduce QE purchases, if not raise interest rates later on this year. But right now, there's no evidence of that happening anytime soon.
So Fawad, I know that you're not going to end this webinar before we talk about gold. So let's have a look at it and
sure.
be done with it.
Let's have a look at gold. Where are you? Yeah, so gold has literally followed this green path that we drew previously.
That we drew last week, yeah.
Last week. And right now it's kind of testing the area where it might come under some pressure, specifically this level.
Yeah, do you think it's time for a pullback? Because obviously we had $100 move basically in since the beginning of May. Yeah, obviously.
So yeah, I mean, if you think about how much of a move this has been, you think some profit taking is warranted at these levels. That being said, because the markets continue to make higher highs and higher lows, what the bulls would want to see is a pullback or a consolidation here before we see further gains. And specifically the 18
before we start taking on the 50% Fibonacci level and so on.
Yeah,
right.
I think this level here, 1845, the base of this recent breakout. So if I move this green box higher, right here somewhere, this is now going to be the most important short-term resistance level, support level that needs to hold. For not only is that the point of origin of yesterday's breakout, we also have the 200-day moving average coming into play right there. So failure to hold above the 200-day moving average would be a strong bearish signal in my view. But if it does hold, then upwards and onwards from there, I think. I can now move my invalidation level slightly higher to this low here. So that's the line in the sand. Even if it breaks below that 1845 level, the technical outlook would still remain positive, so long as it doesn't form a lower low beneath its most recent low, which comes in at 1808.
Yeah, so yeah, I totally agree with you. I'm not gonna be. I wouldn't be buying it before a retest of the 1845 level.
Yeah.
Which is also the 200-day moving average, which has been a very, very powerful level.
Indeed. One final question. I hope this is a final question because we have gone well overboard with this webinar. Is it worth while trading gold, or is it better used as an indicator for the market sentiment and health? I think it really depends on you as a trader. I see no reason why one should not trade gold. It is one of the most liquid markets out there. It's traded around the clock, and you can certainly trade it. If you trade currencies, you should see gold as literally another currency pair to trade. But equally, if you are one of those traders that want to focus on a very specific markets, because that's how you excel, then you don't have to trade it. You can use it as an indicator for sentiment, for market sentiment. So when gold is rising, usually that means that the appetite for risk is falling, because traditionally gold was seen as a safe haven commodity. In recent years, that has changed. People now see gold as more of a risk asset because of the fact that it moves along with bonds, and with the dollar also being a funding currency at the moment. So when the dollar falls, everything priced in the dollar tends to rise, including gold and silver. So yeah, I think it's a wonderful market to trade. I trade gold myself. I know Victor does, but you don't have to trade it, no. All right, guys, thank you so much for joining today. I hope you have all learned something new from us. Please make sure to join us again same time next week. We have a couple of webinars coming up as well. So if you go to our website, go to market analysis, live webinars. Here you can see a list of upcoming webinars. So we've done the live analysis today. We have another one next week, same time. Make sure you register for it. Then Victor is going to identify key trends with gold on 2nd of June. I think I'll be joining him in that webinar as well. We have the non-farm payrolls preview on the 7th of May and so on. So make sure you register for these webinars, especially if you watch this on YouTube or elsewhere, because as you can see, we love talking about the markets that you guys are more interested in. So we'd like to you to join us live and ask us questions. Anyway, thank you so much.
Thank you, guys. And you have a great trading sessions ahead, and speak to you soon.
Take care. Bye now.